Hello, and a very warm welcome to everyone who has joined our webinar today, analyzing last week's UK budget announcement. The budget was never going to be an easy one for Rishi Sunak. The UK borrowed more money than any other time since the Second World War. The support given by the government in terms of furlough, business rates relief, and other COVID support measures have already cost an estimated £325 billion, with an additional £65 billion needed to see the UK through the final stages of the pandemic. Given this situation, there could only be one outcome: a spend now, pay back later budget. Extensions to the furlough scheme until September show that we still have a long way to go to get back to any sort of economic normality. For a government that prides itself on low taxation, Mr. Sunak had to do the unimaginable thing and raise corporation tax by 6%. Although this will not come into effect until 2023 and only applicable to medium to large corporates. That challenge will, of course, still be there in the future, meaning difficult choices ahead with either tax raises or a return to austerity. We are delighted to be joined by two expert speakers to help us wade through the budget and share their thoughts on the challenges ahead for the UK economy. Sharing their insights today, I'm pleased to welcome Loknath Mishra, Managing Director and CEO at ICICI Bank UK Plc, and Arvinder Matharu, Tax Director at Prager Metis. As ever, before we begin the session, I'd like to remind our viewers that they have automatically been placed on mute. If you have any comments or questions, please do type these into your control panel, and we'll pick these up later in the discussion. We will also share a recording with our participants after the webinar. Thank you very much, and I would now like to introduce our first speaker. Loknath Mishra is the Managing Director and CEO of ICICI Bank. He has been with the firm for over 22 years and has extensive experience in corporate and transaction banking services. He is also a non-executive director on the board of Association of Foreign Banks in the UK and is chair of the FICCI UK Finance Committee. Mr. Mishra, thank you for joining us, and we look forward to your remarks.
Thank you, Daksha. Thank you so much for kind introduction, and thank you for inviting me for this important panel. I think this is a very, very important subject given the current context in which we are, and usually I remember the general budgets do not get so much attention, but given the current social, economic and political context where we are, I think this has generated a lot of interest, and I think thank you UK India Business Council for organizing this and inviting me to this important discussion. So I'm sure all of you have gone through the measures which are announced by the Chancellor, and I'm sure you would have seen various commentaries, so I'll keep it very brief. So in my mind, speaking of the budget, frankly, if you look at the context, why did also this generated so much interest? Because of a lot of speculation of where the budget is going to really head towards, which direction it is going to take, and hence there was a lot of anxiety, a lot of interest to see actually what Chancellor presents during the budget. And of course, context is, as Daksha said, we have seen government really play it on front foot, spent billions of dollars during last 1 year to protect the jobs and protect the economy. And in that context, there was, in a way, anxiety and concern among people in terms of which direction this budget will take. And broadly, when we talk of direction, as you can understand, government had two choices to make, and these are not easy and rational economic only choice. These are economic and political choices to make. First one was, given the fact that so much money has already been spent and the situation of public finance where it is, the choice was to really tighten the budget, have a budget which work towards balancing it, increase the tax, and focus on bringing some semblance of sort of conservatism around the public finance. And this was indeed the big fear and concern and anxiety among a lot of people. Second choice was really to let it play out some more time given the current economic and the pandemic situation where we are in. Even if there is a cost attached to us to that in terms of living with the public finance situation with a longer time horizon, let the economy recover, focus on jobs, and then have a longer term horizon to really bring it back to control. So as you know, people generally are happy, and I'm happy, and I'm sure all of you are happy with the fact that government has chosen a path which is the latter path, which essentially means that now is not the right time to really tighten the belts. It is the time to continue to support the economy, support the jobs, help the economy recover, build it back, and then have a plan to really repair the public finance. And of course, this choice, what was made by the government, was in a way also supported by two things. One is there is generally, both politically and economically, there is a broad consensus in terms of continuing with these measures, and there is much more appetite and acceptance of the economic and political opinion in favor of continuing with this kind of measure. So in that sense, that is what even institutions like IMF have been supporting. So to that extent, it was in line with that, and we have seen a lot of other countries taking similar measures. You have seen US announcing $1.9 trillion dollars of package, and likewise for other countries. So it is in line with that. And of course, second, economic logic and reasoning for, and in a way, one of the mitigant, despite this very difficult situation for everybody, and right, and so that so is for the government, is the low interest rate environment. So despite a significant increase in borrowing, the interest payout for government is still lower than what it used to be a few years back. So these are in a way a great positive of this difficult situation that helps government carry on with higher debt without really impacting the debt servicing capability. So on the whole, given that context, I think this is a great budget in the sense that it chose a path which supports the economy recover, bounce back, build back, protect the jobs, supports the companies reopen and restart their business. So variety of announcement which really helps these measures to see the economy come back on track and really revive the consumer sentiment. And the thought is, of course, once we have the economy reopened, with the balances what has been built by a lot of people, it will, a lot of them will spend, and that will drive the consumer demand once the economy opens up. And a lot of measures also to really revive the investment. So super deduction scheme, what has been launched, is very timely, I would say, because this is the time when a lot of companies will be tentative and will be thinking about whether to do the capex now or really wait for economy to revive. So in a way that gives an incentive to prepone and front load some of these capex and investment. So my sense is that I would say that it is a great budget in the context of getting back the economy on track, reviving the sentiments and supporting the sentiments around consumer investing, as well as investment by the companies on the capex side. So that's broadly the thinking, and on the back of that, the estimate shows that the rate of growth this year is likely to be about 4%, and next year it is expected to be about 7%. And this again is one of the highest rate of growth. Of course, we should not forget that this is on the back of a massive reduction in the growth, and the size of economy is smaller compared to what it used to be. But nevertheless, I don't think we should wish away and sort of discount the potential for future growth. And that is where I think the budget has taken a path which supports this growth of 4% this year and 7% next year. I would say that there are two risks to this, two downside risks to this, and even last week we heard from Bank of England governor talking about this, to say that potentially it could have two different kind of outcome, and these are of course dependent on various parameters. One is it is possible that everything works well and we see a massive rebound of economy. And of course, downside there, which we should be mindful, is the increase in the rate of inflation, which everybody is concerned about and worried about, because any uncontrolled increase in inflation can have substantial impact and can show up in the variety of ways, including the fact that cost of borrowing goes up for everybody, including for government and stuff like that. So that is clearly one concern and worry people have. Second is, of course, if the virus does not get controlled, and if we see, unfortunately, any third surge and stuff like that, so that could have potentially a downside impact on the economy. Fortunately, I think as a country in UK, we have seen massive progress and very, very commendable job in terms of vaccination. It is one of the best across the globe. And it appears that by summer, we should have a fairly large percentage of population which is vaccinated. And hence, it appears that it should be in control, and hence that downside risk hopefully should not play out. So I would say that on the whole, I'll give very high marks to this budget, and I would say that on the balance, I would be optimistic and look forward to a good growth for both for this year as well as for next year. So that's all from my side. I'll of course be happy to take questions during the Q&A session, whatever is posed by Chris once we have completed the presentation by Arvind, I think. Thank you so much.
Thank you, Loknath, for those insights. Before I invite our next panelist, I'd like to remind our viewers to keep those questions and comments coming in, and we'll pick these up in our discussion shortly. I will now ask Arvinder Matharu to share his insights. As a brief introduction, Arvinder is a director in the tax department of Prager Metis and has been in the accounting industry for over 10 years. He focuses on providing tax consultancy on a range of issues such as trusts and estates, inheritance tax planning, capital gains tax, remittance basis and non-domiciled planning, residency planning, and advising on R&D tax credits. Arvinder, over to you.
Thank you, Emma, and welcome everybody to today's budget presentation, and thank you to the UKIBC for having me here. Next slide, please. So, when Chris invited me to be a co-panelist, I asked him what exactly he was looking for in today's presentation, and it looks like Loknath got the same brief, which is give us a general overview and the direction of travel. So I would be giving a general overview, but I will also be giving some specifics with regards to corporate businesses. And a lot of what Loknath has said today, I actually share, because the aim of the budget this year was to support businesses, to extend the various support schemes such as furlough and grants for the self-employed, as well as trying to lay a foundation to hopefully promote investment going forward that will hopefully get us out of this pandemic and the economic crisis we're currently in. Next slide, please. So it was mentioned at the beginning that corporation tax rates will be increased from 19 to 25%, effective from 1st of April 2023. Just to confirm that it will not affect companies with profits of £50,000 or less, as they will continue to be taxed at 19%. Next slide, please. So the 25% rate will only hit those companies with profits in excess of £250,000. For companies with profits of £50,000 to £250,000, they will have a tapered rate. Now, for those of you who worked in UK corporation tax in the past, this is a return to the marginal rate relief we had about 8 or so years ago. Next slide, please. Now, in terms of a support measure and more to promote investment, the government announced the introduction of a super deduction capital allowance for companies. It's available only to companies, and it will come into effect from 1st of April 2021 to the 31st of March 2023. So the relief will allow companies to claim an enhanced rate of capital allowance, which is a tax form of depreciation. So the enhanced rate will be 130% super deduction qualifying capital allowance on qualifying plant and machinery, and a 50% first year allowance for qualifying special rate assets. Next slide, please. The super deduction at the enhanced rate of 130% will allow companies to cut their tax by up to 25p for every £1 they invest. So as an example, if a company acquires £100,000 of qualifying plant and machinery, let's call it a new mainframe computers, the super deduction at 130% would give qualifying expenditure of £130,000. With tax relief at 19%, this would give a tax reduction of £24,703, which is just under 25%. Now, the aim of this measure is to promote companies to invest their cash into themselves and as a result into the economy, because a lot of companies, the bigger companies certainly, are sitting on a lot of cash. So this is a very good measure by the government and one that has been positively received. Next slide, please. Now, the temporary extension to carry back of trading losses. This is a very important support measure for companies and unincorporated businesses who have incurred serious trading losses during this pandemic. Normally, you can carry back a trading loss by 1 year. Under these provisions, a company will be allowed to carry back trading losses from the current 1-year entitlement to a period of 3 years, thereby generating greater tax repayments, which they would so badly need in order to improve cash flow. Now, for companies, the relief is available for losses incurred in accounting periods ending in the 1st of April 2020 to 31st March 2022. Next slide, please. Now, losses will be carried back to later years first, and there's no limit to the amount of loss that can be carried back to the preceding year. However, after carrying back to the preceding year, a maximum of £2 million of unused losses can be carried back to the earlier 2 years. Next slide, please. So, as part of the budget announcement, the Chancellor announced the creation of free ports at various locations in the UK. Now, a free port is an area with a geographical area of a diameter of up to 45 kilometres, closely linked to a seaport, airport or rail port. Now, the whole point of a free port is for it to be a national hub for global trade and investment across the UK. It's also meant to provide valuable regeneration in deprived areas, hopefully creating new jobs and again investment into those areas. Next slide, please. Now, I'm not going to go through all of these benefits, but there are various customs and tax benefits in these free ports. To name a few, there's duty deferral while goods remain on site, as well as property tax breaks from stamp duty, land tax, and enhanced allowances on building constructions or purchases in a free port. Next slide, please. The release will apply for expenditure incurred from various dates in 2021 to 30th September 2026. And we eagerly await further detail on free ports in order to advise businesses whether this is something they should be considering. Next slide, please. So what does all of this mean for Indian businesses investing in the UK? Well, free ports could be a consideration, but again, subject to further detail, which will be coming in due course. In terms of research and development tax credit scheme we have in the UK, it's currently one of the best schemes in the world. But the Chancellor announced some reform to the scheme. There's a perception amongst the government that the R&D tax credit scheme is being abused by various businesses in the UK. Currently, the scheme as it stands allows loss-making small medium enterprises to surrender a loss in return for a 14.5% payable tax credit. From 1st of April 2021, that tax credit would be capped in any 1 year at £20,000 plus 3 times the company's total PAYE and NIC's liability. By PAYE and NIC, we're talking about payroll taxes. So to give an example, if a company's payroll tax bill is £5,000, at 3 times that gives £15,000, plus the 20k gives a cap on the R&D tax credit of £35,000. Next slide, please. And also, as we've just discussed, the super deduction is a very attractive relief, a very welcome one, and hopefully that will encourage companies to invest more into themselves and into the economy as a result. Next slide, please. Now, in terms of direction of travel, the message given earlier, which I totally agree with, is spend today and tax tomorrow. To have an investment-led recovery that provides targeted tax relief to promote growth. And the aim is to promote an investment-led recovery, not just with tax reliefs, but with non-tax initiatives such as funding for companies working in life sciences, clean technology, and other areas. Next slide, please. And also reforming the immigration system to attract the brightest and best international talent. So the government here is trying to create an environment of growth, and hopefully the tax revenue will follow. There is, however, a possible sting in the tail. So we've got to be aware of tax day. Tax day is on the 23rd of March, and it's a day on which the government releases a number of consultation and reports. And it's meant to set out the government's 10-year tax policy. Basically, it will give us an idea of possible future tax rises, because in the short term, at least, based on this budget announcement, the government is trying to support businesses and promote investment. Inevitably, there's got to be a series of tax rises one day to plug the deep financial hole that we have. So tax day 23rd of March may give some indications of the future direction of travel, as well as the autumn statement later on in the year. Following the announcement of various economic forecasts and results, we may have a better idea of future tax rises. So be aware of those two very important events. So thank you for listening, and I welcome any questions.
Thank you so much, Arvinder, for such an interesting presentation. I'd now like to hand over to UKIBC Director Chris Hayes, who'll be moderating our Q&A session. If you have any questions for our panelists, please do drop these in your control panel and we'll pick them up. Thank you, Chris, and over to you.
Thanks very much, Emma, and a huge thank you to Lok and Arvi. You met the brief perfectly, Lok setting the overall macro initiatives that the budget was trying to set, and then Arvi, you going into some interesting detail on that. Just a reminder to everybody, yeah, please keep your questions coming through, and I'll start to put them to the panel. I'm going to start with you, Lok, if that's okay, and sort of your overview of the budget and where you consider the areas of opportunity for the UK-India corridor to be, given the announcements that have been made.
Thank you, Chris. I will cover it in three parts, if that's okay. One is, of course, the general relationship between the two countries. And then I'll briefly talk about UK companies seeking to invest in India, and then Indian companies seeking to invest in UK. So first is I myself in a way new immigrant into the country. So I came here about 2.5 years back, and what I have seen is there is a fairly strong relationship between the two countries at people-to-people level. So a lot of Indian business promoters and business communities have family offices, have very strong presence and linkage with UK. And in a way, I would say that if India has to look at some of the foreign geographies, UK should come right in top in terms of doing business because of the language, culture, the fact that the communities are known to each other. There are so many of Indians which are in UK, the legal system, and all of that. So I think it's clearly a case where there is a shared history, culture, language, legal system, which are very similar in that sense. The size of the economy, if you look at both the countries, are now of similar size in terms of GDP. India, of course, is expected to grow quite substantially from here, given the demographic advantage what the country has. And this year, growth target for India is about 11%, so that shows the potential trend. And the country aspires to become a 5 trillion economy in next few years. So I think the case for much stronger working together for both India and UK is very, very strong, I would say. That is first. Second is also if you look at the current thinking in both the countries, which is demonstrated by budget both in India as well as in UK, is very, very pro-business oriented, very growth oriented. There are complementary skills in terms of areas which are identified as area of strength and focus in both the countries. For example, technology, science, innovation, all of that are the area where I think there are a lot of opportunities for both the countries to participate. If we come to specific to Indian companies investing into UK, I would say that, as Arvind highlighted, there are quite a few budget initiatives which are focused around spurring the or really increasing the investment opportunities in this country, starting with the proposal on free ports, which could be used by Indian entrepreneur to really use this as a hub where you produce and then sell, and then that has a lot of advantage in terms of the tax duties and all of that. The investment scheme what the government has announced, the whole focus of the economy in terms of science, technology, life sciences, those are the area of strength even for a lot of our Indian businesses, and hence it can work very, very closely. So for example, the vaccine is a very good example of innovation taking place here, and a lot of that production taking place in India. So I think there are significant opportunities in some of these areas what we have seen where people can invest, and there is other proposal which of course we have to see the details of that, and in my view that could again be a game changer, because we see that trend picking up very strongly in India, which is of technology entrepreneurs really setting up companies and growing, and what we have seen something like in Silicon Valley and all of that. So that is a very, very strong trend already happening in India with very bright technology graduates from IITs and all of that. Now, I believe that the initiative what UK has announced in terms of giving unsponsored visa to some of these bright technology people is something which could be used and availed by a lot of this kind of entrepreneurs to really use UK as a base. And again, I must say that I have seen it firsthand. UK is clearly emerging as a very, very strong destination for fintech and a lot of this technology kind of initiative. So the benefit what the Indian entrepreneur and technologist will have is the experience and benefit and availability of talent and the technology of a developed market. And that's unparalleled here, what you see in terms of the resources and talent what you can get from all across the globe here is unmatched. So clearly, I think that would be another area for cooperation. So life sciences, technology, innovation, R&D, I think those are the areas which are clearly big areas for potential opportunity. Other than we have to see how do we make a business case for Freeport. I'm sure there are opportunity around that to be used as a hub for manufacturing and export from here. As far as UK companies investing into India is concerned, again, similar to UK, I would like to highlight that in India, we have announced various measures, and one of them is called, for example, production linked incentive, which is available across 15 sectors. And that's again is something which a lot of them are looking very, very closely. We have a big market in terms of fintech, so kind of growth what people are expecting both in e-commerce and fintech is very, very substantial jump from where we are today, and that's enabled by availability of broadband and the bank account and the smartphone what we have the penetration in the country. So that is a massive area of growth for the country. And the last one, we are seeing huge growth and interest from a lot of companies, not only from UK but also from other countries, is to create in a way a R&D center in India, Global Innovation Center India. So a lot of them are already working to put massive global centers in India, and that is one area we find a lot of global companies are looking towards India. So clearly, I think there is a very strong case for investment into India, because the belief is that next decade is going to be the decade for India to really grow and emerge as a big economy globally. So that's all I would say. Chris, thank you for asking this question.
No worries. Thanks very much for such a comprehensive answer to that. Thanks, Lok. Arvi, over to you. And this is where, as a chartered accountant, I love asking other accountants technical questions. Always good fun. You talked about the super deduction scheme there, obviously 130% on qualifying plant and machinery. Is that just a rebadging though of previous writing down allowances? And from your perspective, is there anything that's trying to entice businesses to look perhaps to reduce their carbon footprint, sort of giving your R&D tax credit sort of specialism? How could a business use the two to maximum effect?
So the 130% enhanced rate, if that wasn't in play, the rate we'd be looking at is 18% ordinarily. outside of the annual investment allowance, which does give 100% write-off. But once you've extinguished the AIA allowance, you're then down to 18% writing down allowances. So this 130% enhanced rate is very welcome for those companies who would so easily burn through the annual investment allowance, which is, apologies, I can't remember. I believe it's £1 million as it currently stands. So it's a very much welcome move. And in terms of carbon footprint and the R&D scheme coupled together, this may give companies greater advantages and cost efficiencies in developing those technologies, or as well as acquiring the capital equipment needed to reduce its carbon footprint. Apart from that, however, I'm not an expert on the carbon footprint field, unfortunately. But I have had some clients ask about the greener movement, how they could turn to greener technologies and the cost involved. And there are some, I believe there are some government schemes we're looking at where you do get the subsidies for investing in greener technologies. And so that's something we're looking at currently.
Yeah, and you would envisage obviously any investment in new plant or machinery would naturally be more energy efficient anyway, just obviously through technological advancements. So
yeah, I mean, I would further add, I think the thing we're having more queries from clients is regarding electric cars.
Yeah.
And one of the questions we've had is whether the 130% reduction will be available on electric cars. Now, unfortunately, as we're still going through budget details, it's not something I've had a chance to check, but I'm hearing mixed commentary from some top experts giving contrary views, some saying you do get the enhanced allowance and some people saying you don't. So it's there's clearly some confusion there. So it's it'd be an interesting one to find out.
As always with all the budgets, the devil is in the detail, which is often released sort of later on. So I think we'll be obviously interested to see what does the qualifying plant and machinery cover, and obviously on that super deduction, what will it be all about? I think given obviously the UK's net zero task and obviously the hosting of COP26 this year very much will be in line with those sort of sustainable goals that the UK is pushing. Sort of linked to that, I've had a question come through in terms of the sort of, I guess it's linked a little bit to the free port, but it's looking at sort of the UK post Brexit really, and sort of, I'm keen to get both your thoughts on this. Did you see anything in the budget that would support Indian investors who perhaps are looking at the UK as a base for obviously continental Europe? Obviously pre-budget that was a lot clearer in terms of that side. Obviously post Brexit there is there is zero tariffs, there is obviously the free trade agreements, etc. But was there anything from your mind, any worries that your clients or customers are having, and is there anything that you saw which was in the budget to support the businesses? Locke, perhaps start with you.
Thank you, Chris. I think it's a important question and decision for all the companies who are seeking to service the continental Europe. What I see among some of our companies is they are looking at as of now UK and Europe separately in that sense, because while there is the trade agreement between UK and Europe, I guess a lot of them are either waiting for this to settle down and see how does it work exactly like what it was prior to Brexit in terms of the business transaction from UK to Europe. So that's where is the current thinking of some of the investor, but I'm sure some of those concerns clearly get addressed by the trade deal, and I'm sure after some of these teething troubles it will settle down, because this is clearly a big change, and obviously there are some initial hiccups here and there, but hopefully over a period of few months it should settle down, and that should give better enablement for companies to really service Europe from UK.
Yeah.
Second, of course, as you rightly mentioned, again we'll have to go through the details of the final policy, but free port probably could be an more elegant alternative, is what I think.
Yeah.
To create this as a base and then export into Europe. So I would broadly say these two things on this case. Thank you so much.
No worries. And Avi, anything to add on that?
Yes, it's interesting because, as Locke says, it's interesting to see the detail when it comes out. From what I've read, free ports seem to be successful in Europe.
Yeah.
Obviously untried in the UK. Some critics I have heard said it doesn't create new jobs and it creates economic distortion. So the jury is out on free port, but I think overall it seems to be positively received overall. But again, let's wait for the detail. It'll be interesting to see what that says.
Yeah, and sort of linked to that, yeah, you're right, Avi. I think the UK government did sort of try it, but dipped their toe in the 1980s. Obviously, I'm from Liverpool, which was one of the original free ports. But as you say, it's distortion, obviously, has that benefit of goods technically not have landed in your country, so you can assemble and repackage, etc. But given that, it was interesting to note that those free ports were the traditional ports, as you were the seaports, and obviously now many economies are multimodal, and especially obviously air freight is much bigger given the high value of certain goods and the perishability of other goods. So I think I was intrigued that there was only one airport, the East Midlands, mentioned as part of that, whether that was because obviously it's part of the levelling up agenda. There are of course no ports in the Midlands, so perhaps that's what come about. But do you envisage that's the sort of the direction of travel, is that future free ports as they come on board will take more airports on, or will it continue to be that sort of traditional port, given the carbon impact, for instance, that the air travel has over the shipping? Arvi, if we start with you, just give your thoughts on that.
Interesting question, difficult one to answer, given that again, waiting for the detail to see how that works and what the long-term ambitions are with free ports. But it's interesting that you asked a question in the context of carbon footprint.
Yeah.
So it's possible that yes, airports may or may not take on such a bigger role on this, given their carbon footprint, unless we have less carbon emissions from planes as technology improves.
Yeah, that's true. That's a good point. That's a good point.
So,
Lock your thought. Oh, sorry, Avi.
No. And who knows whether there'll be more free ports in the future. So it just depends maybe on the success of these ones initially, and let's see if they roll them out further.
Yeah. But Lock, anything to add on that?
No, I think you are absolutely right in terms of the current thinking on free port, but I would sense that probably government will wait for some time to see how does it actually come up, how does it actually work in terms of directionally, is it a successful model or not. But I agree with you in terms of as a concept, while we have been used to a seaport being the hub for import, export, and that in a way looks like a natural place for free port. But with the changes in the logistics and mode of transport and all of that, I think it's not something which should be ruled out, because so one is of course free port based on an airport, but I'm not sure whether there is a story around also the railway linkages, because that's quite a, I would say that I'm not an expert again, but I would say that's a fairly robust infrastructure which is already here and can be in that sense potentially be created, and that could in that sense will address your concern in terms of probably the carbon impact of transportation through sea versus train versus airplane, and probably the airplane is more on the outer side in that sense. But I could guess that probably train could be somewhat much more acceptable mode. We are seeing substantial progress in terms of train linked similar thing, not really free port, but some similar concept in India are taking place, and they are coming up.
Yeah, and that's the same. Obviously, that's happening in the UK at the moment with HS2, HS3, which for me was always interesting. It was not really about the speed; it was more about the capacity. Obviously, in the UK, we have freight and passengers sharing the same lines. With the dedicated high-speed lines, you then have dedicated passenger lines to allow more freight to travel in a very low carbon way up the old routes. Still a good speed.
Sure.
We've got a question coming from Prager, who's basically asking, obviously, given the UK and India's history, language, you mentioned the diaspora that are in both countries as well. I guess that the UK India trade has never really sort of punched at the weight that it should be. Did you see anything in the budget lock that might sort of help that? Obviously, there's been recent reports around the £25 billion of export that happens both ways, and initiatives that are trying to double that. From your point of view, and obviously the conversations you're having, do you see the budget helping in that area?
I am not sure if there are specific initiative on the budget side, but I, of course, hear very strong desire from both the governments, and as you can imagine, there are a lot of government engagements which are already lined up between India and UK over the next 3-4 months, and I'm sure you will see a lot of them coming up. So I think there is a very strong desire, and already the work is happening between the two government, I would sense, in terms of trying to do a basic deal first in terms of trade deal, and then probably eventually look at expand it further to something like potentially a free trade deal. So I think that's a good initiative, and that is in any case we believe could be the potential benefit in terms of relationship between the two countries post Brexit. So clearly that is the area of travel, and I'm at least what I'm hearing is that there is a serious effort being made on that, and hopefully we should hear something on that.
Yeah, excellent. Thanks very much for that. We've got another question from James. This is he's looking at the current currency sort of volatility there is in the market, and again to you, Lok, whether you think that there's any concerns that UK businesses might have sort of investing in R&D centres, e-commerce in India, given obviously the high cost of hedging currency in India, and also be interesting to see if ICICI have any products or solutions that could help with that.
So good question, Chris. I think you are right. If you look at GBP Indian rupee conversion, that had changed from low 90 to now about 100. So earlier 1 GBP would give you low 90, now it gives about 100.
Yeah.
And of course, as you know, currency is a complex function of your exchange rate between GBP and dollar and rupee. So multiple factors impact the factors which impact GBP, factors which impact dollar, the factors which impact rupee. So in that sense, it is a function of both of them, and of course, broadly, globally, dollar has been weakening against other currency. That is obviously one of the main reasons for this change, as you can see. So from the perspective of the UK-India trading partners, the companies which are investing into India, or which have development center, or which trade into India, obviously this is an important part of their economics to really look at when they do their business planning and all of that. Now, good part is that two things I would say. One is depending on the kind of customer and situation we are in. Now, Reserve Bank of India allow a Indian exporter, including the services and the development center, to invoice the UK company in Indian rupee. So they can actually invoice it in rupees, so that that unit is not impacted by the fluctuation. But of course, that fluctuation has to be managed in UK. So that again, in UK, we have a fairly developed market in terms of your ability to hedge GBP to rupee. So if you are a customer dealing with India and if you have a rupee exposure, it can be managed either in India for you by your Indian entity, or it can even be managed by the parent here in UK by UK banks, and ICICI Bank provides this facility both in UK as well as in India. So it's a fairly well-developed, very strong hedging market which is available, where you can hedge it for again fairly long period of time. It's a liquid, reasonably liquid market. So if you want to be very certain about your business plan, there is potential to hedge it. Again, you can hedge it in UK, you can hedge it in India, and have much more certainty around it. But yes, as a developing country, when you invest, you have to plan and assume certain kind of depreciation. Typically, we have seen in the context of rupee dollar, we have seen depreciation of about let's say 4% or so over a long period of time. And there are variety of instrument available for hedging, which we are happy to provide to our customers.
Excellent. That's really good to know. Obviously, we're coming towards the end of the webinar, so a final question from me, which is linked to Lockie. You sort of touched on it before. Obviously, the UK and India government, there's been a significant amount of progress in sort of bilateral negotiations recently. We obviously saw Dominic Raab go to India, and then Liz Truss go to India, and of course there are rumours that the Prime Minister will be going to India in the not too distant future. Given that, and obviously the direction of travel that we're on towards a free trade agreement, but taking into consideration that free trade agreements will probably take at least 2 to 3 years to negotiate, what can the UK government do in those 2 to 3 years to attract more investment from India? Perhaps looking at for you from the macro point of view, and then Arvi, if there's anything on the tax side. Obviously you mentioned the increase in corporation tax, but if there's anything that they could do to bring those incentives on. Locke, so we start with you.
Thank you, Chris. I think it's a good question. I would say that there is already a significant focus and work being done by various entities like you and DIT and CBI. So I'm sure there are a variety of business facilitation which is happening by various departments. But I would say that probably a sectoral focus in terms of identifying the area of priorities which matches both for UK and India, and which adds value to both of them, and then taking a sector-wise approach and initiatives would probably can give faster results. And I'm not saying it is not being done. Probably this is being done, and people are thinking about it. And clearly, as I mentioned earlier, there are certain areas which stands out as an area of cooperation between the two countries as in a way like a no-brainer. So I would say that a sectoral, very focused initiative on sector by sector basis could potentially give some quick results, I would say.
Okay, thank you. Arvi, from your point of view?
Thank you, Chris. From a tax perspective, it's difficult for the government to possibly provide any further support in the sense that the super deduction, for example, is a short-term measure. So it's not going to last for too long when it does come into play. And they've capped R&D relief for small and medium enterprises. So there's a bit of a mixed message there, unfortunately. And though not discussed in my slides, there's now a stamp duty land tax surcharge for non-residents buying UK residential property. So there's a discouragement there for investment into the UK. So short term, there's some good messages. Long term, it remains to be seen. So the government probably needs to try and achieve an ideal balancing act that doesn't deter businesses but encourages them to invest in the UK, and why it's trying to fill that black financial hole that they have currently.
Yeah, I think you hit the nail on the head there, Arvi. It's, it was, for me, it was very evident that the UK government was, continuing to push that research, development, design, the UK to be the place where you design, you make, you bring intellectual property, etc. And obviously things like the patent box, are already there in existence. Adds to that the R&D tax credits, add to that the new super allowance as well. It very much shows that it's all about the investments in that sort of new technology strands. Well, we've come to the end of this UKIBC webinar, so it's just left for me to say a huge thank you to Lok and to Arvi for providing their expert guidance, and thank you very much for answering what was some difficult questions. For everybody watching, you will receive the video copy of this in case you want to watch back any sections. Please feel free to share this with your colleagues as well. To keep up to date with activities that are happening in the UK-India trade corridor, you can always follow us. It's at UKIBC, as you can see at the bottom of the screen. You can follow us on LinkedIn, just type in UK-India Business Council, or if you go onto our website, you can sign up for our free monthly newsletter. And the same goes as well for Prager Metis and ICICI. You can log onto their Twitter accounts, and I wake up every morning to an amazing analysis from ICICI about what's happening in India every day. So I'd encourage you all to do that as well. So a huge thank you to the panelists. Stay safe, everybody, and I look forward to seeing you on the next UKIBC webinar. Thanks, everybody.
Thank you.